And good evening, good morning, wherever you are in podcast land. Brendan Cunningham, the real estate doctor here at EXP. We have guests, we have thrills and spills. We have Matt Paul. He's going to tell all the things that you need to know about real estate. And as we always commit to all of our listeners and viewers, we do not tell you what you want to hear. We tell you what you need to know. Quick little recap of what's going on in the marketplace. Give me your read, Matt Paul. What's going on in the local market here in Buffalo? Our guest is in
Yep.
California, so
Yeah, we're just, as we've been mentioning the last few weeks, we're seeing a surge of inventory. Still hearing about multiple offers, 20 plus offers on really nice hot properties. And, it's pretty competitive out there.
yeah, and my phone blew up today and yesterday with guys I haven't heard from in like a long time. They say, "Hey, I need to do this. I need to do this. I need to do this." Listing. So I've really seen like a serious spike just in the last week of just stuff that's going on in our local marketplace. However, we talk to buyers, we talk to sellers, we talk to investors, and sometimes, we talk about supply and demand. We talk about, what you should be looking for. But a lot of times we don't take the time to actually break it down and get into some of the numbers on why you might want to make an investment. And we have Amish with us this morning, who's going to tell us all about some of the stuff. Matt, do you want to see, since you discovered this fellow and he's a great investor and advisor, what do you want to tell us about him that we should know before he starts talking about himself?
Yeah, so Amish was kind enough to have me as a guest on his podcast, Main Street Minds, and it was a really great podcast. He's trying to bring value to his clients and potential clients as well out in the southern or northern California. Is that correct, Amish? Yep.
Yeah.
Yep, and and he's also has a really good background in lending as well. So that's what we'd like to discuss today about different possible ways of financing projects, commercial investment projects, that sort of thing.
Amish, take it away. It's
Great.
on.
Thanks a lot. I really look having a great start to the day with speaking with both of you and reaching out to everyone that's listening to this podcast. So thank you for making this happen. Before I get started, I think most
So
people wonder
talk
like
about what
what
you do.
is lending? How do you really make an investment when the interest rates could be like 3%, 4%? Maybe at 10%, a loan at 10% is pretty expensive and rare. But how do you make a really good return in lending? And I think that's what I would like to explain like today and to the audience and like kind of share some inner world secrets of how lenders make money, why very large investors tend to be on the debt markets. Majority of the money in real estate, 80, 90, 70 to 90% of the money is debt financing, right? If you're buying $1 million property, 700,000, 800, 900,000 could be debt. And that everyone else that says, hey, I'm investing in a real estate and I'm going to put 20% down. Why do large money, major money, focus on debt and not on equity, right? Why doesn't or also at the same time, why does the bank, if they can give you 80, 90%, why don't they just give you the 100% to buy the
Yep.
everyone would love it, right? So these are some of the secrets that I would like to kind of share with the audience and explain how the lending world works, why lenders do stuff that they do. But before I get started with that, I just want another common question most people ask me is, why did I even select this, right? How did I even come to where I am today? So when I started doing investments and flips, I did my first project all cash, small project in Sacramento, pretty easy to handle, made some money. And then when I was doing my second project, I said, okay, let me step up the game a little bit. Let me do something a little more complicated, a major rehab, right? Structural work and everything involved. I was trying to do a project in San Francisco, and the numbers looked really phenomenal, but nobody wanted to lend money. This is 2019, 2020, when the market is extremely hot. Obviously, COVID was around, so that was one of the reasons why most lenders were being conservative in lending. And I found a very similar deal in San Jose, California, like both somewhat reasonable affiliated markets, right? Both Northern California, both Bay Area, similar price points. San Francisco was at that stage at least still a more premium, more attractive market, but I wasn't getting financing and lending for or money for that project. And for a very similar project in San Jose, I completed the purchase in 10 days with financing, with hard money loan, with private money and hard money. So that's what got me interested. And then as a few years went by, we see the difference between the markets. San Jose is doing amazingly well. San Francisco took a very big hit, just unimaginable turn of real estate in San Francisco. And that's what got me interested at that stage, saying, I need to know where money moves. Maybe the markets shift based on where the money is flowing and where is the big money moving. That's what got me interested in lending, saying, if I want to make good uh, investment decisions of my own, I need to know where big money is moving.
And you need to be
So
like
that
one step ahead of that too, right?
exactly.
Yep.
I'm not getting financing for some project. More than likely, something is wrong over there that I have not seen still. That other large money is already observing and experiencing that I still haven't experienced, or I'm falling for something that may be a little difficult. So that's what got me interested, and that's how I got my lending licenses, became a lender, and like started like lending my own money as well on real estate projects. So that's how I got started. And following up with that, I think just sharing some of the secrets of how lending works. There is a very big secondary market in lending. So when we get a loan from a bank, when we get a loan from anywhere, right, mortgage banker, direct lender, anywhere, they ask us a lot of conditions, a lot of requirements. The way to understand and justify what those requirements are, whether they are genuine or they are not, is based on how the foreclosure laws work in that market. So, for example, a lender might need the spouse to sign on a document in a community property state, because in a community property state, the spouse has equal rights to the property as the borrower or the owner. Even if the spouse is not on title or the spouse is not on the loan, they have equal rights to that property. So when the primary spouse, the borrowing spouse, is asking for a loan, the spouse has to allow that person to take that loan, because they are equally liable and they have equal access to the property. That's like that. Just that understanding helps just calm down some nerves while borrowing money from a bank. Saying, wife is not on the loan. Why does the wife has to sign on the loan? And on the east, on the judicial states, on the non-community property states, majority of the East Coast, the wife doesn't have to.
Yeah, that's how it is in New York. Yep.
Yeah, exactly. So it's not a community property state.
Yep. Exactly.
So that's one of the reasons. So if you understand the reasoning of how foreclosure works, that will help you understand why the law exists and why the lenders ask for certain documents. Uh, and at the same time, some lenders are not as experienced. I had a lender from New York doing a loan in California, and they were like, "Give me hurricane insurance." I was like, "What was the last time a hurricane happened in California?"
Yep.
And are you sure you don't need earthquake insurance? And they're like, "No, we don't need earthquake insurance." I was like,
Yeah.
"This is terrible."
It's it can even be that different from where we are in Western New York to New York City. New York City is totally, when I deal with lenders on loans here, it's the same type of issue. They ask for things that don't exist.
Exactly. Make any sense? Like, I'm like, so if we understand what is required for the foreclosure, what happens afterwards, right? Once the loan is originated, that will help explain and understand like why the lenders ask for certain documents. One of the things that I was very fascinated about is, how do we make a 20% return on a 3% interest rate loan? So the secret is the secondary markets. So between getting a loan and paying it off, there could be years or decades in the middle, right? The loan doesn't sit with one person or one bank or one institution. If it's $1 million loan, it gets sliced into multiple different segments. 100,000 could be from Bank of America, 200,000 could be from Chase, 500,000 could be from AIG. Like, they all come together, bundle up their money, and splice up that loan in the secondary market. So when that's when let's say you're trying to negotiate a short sale with the bank, you're trying to negotiate a foreclosure with the bank. It's not one person making that decision. It's like 20 people coming together and all agreeing on one thing, which that's the reason why we don't get answers on many times when we are trying to negotiate with the bank, and it feels so frustrating saying, yes, it's happening, we are going to respond back tomorrow, and then 1 week later we still don't have a response because 20 people have to come together and agree on the risk. One person is willing to take the discount, other person is not.
And I was going to say, and that's if they agree on it, right? They don't necessarily always agree, you know?
One person is like, I'm fine, I don't want the money right now, I'm going to take the risk and get the full amount, I don't want to give a discount on my loan. And the other person is like, I am bleeding money right now, I don't mind giving away 20% discount, but give me that 80%.
Yep.
Yeah, so that secondary market is very interesting. And even if the interest rate is just 3% on the loan, when the loan is performing, when it's a new loan and it's a performing loan, if there are payments happening for 3 to 5 months, then that, let's say the loan is $1 million at 3%, we are able to sell that loan at maybe $1,050,000 to a secondary investors because their requirement was a 2.9% return on investment, right? Versus the loan is at 3. They are like, oh, I love that extra interest that I'm getting. It's performing. I'm willing to pay you 50,000 more because my return expectation is just 2.9 and not 3.
Gotcha. Okay.
So when we originate a loan of $1 million, we made extra 50,000 by selling it to somebody that has a lower return expectation.
Okay. And so how can you tie that into the bigger, the larger, net value properties that you were originally talking about, where you can get, the 70 to 90%, financed, and to say it's a multi-million-dollar development, or, big project.
Yeah, and all of that comes down to uh, lenders only look at one thing: will I get my money back? Right? If they are putting $1 million into an asset, they really don't mind how much is the return on the interest. All that they care is, will I get my $1 million back?
Mm-hmm.
Like, and how confident I am that I will be paid on time every single month, because the money that large institutions have borrowed from other places, they have promised a return to their investors, right? For example, you might have a 401k that or a life insurance policy or other annuities. They have committed returns of saying, I'm going to give you a 5% return on your policy, right? They need that 5%.
Yeah. Yeah.
If that gets impacted, it blows up, right? Everything falls apart.
Yeah. It hits their bottom line.
And
Yeah. Yep.
yeah, so the assurance is way more important for a lender than the return.
Okay. Is that like personal guarantees? Is that a part of it as well?
Personal guarantee helps,
Yeah.
yes, because that if personal guarantee helps if the borrower is good.
Yeah.
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 If the borrower is bad, it's like, oh yes, this is exactly the loan I don't want to do.
Yep. I've
Yeah.
seen that in the
So
past.
yeah, so if somebody is willing to personally guarantee it, cross collateralize it, or like do something, then we can increase our loan to value ratios.
Okay. So that's how the bank really does it on the back end, is it's just, due to the risk. That's how they kind of adjust it. Okay.
Yeah, they're like, how assured am I that I'm going to get my money back? And the reason why they lend only 70, 80, 90% is if the market switches, if there is transactional cost, if I have to go to foreclosure to even get all my money, there are costs associated to that, right? So a foreclosure on an average is $12,000 for the bank, right? And if it gets complicated, if somebody files a bankruptcy, it can be up to $50,000 or $70,000 of loss. So that difference in the price of the asset to the loan amount covers that gap.
Okay. Gotcha.
Yeah, and then the question comes like, how does FHA, how does VA, what are they doing to give us 100% financing, USDA and all of them, right? And over there, it's the government assuring the bank saying, if the borrower if the borrower defaults, the government is giving that insurance that they will pay for it. And how does the government get that money? The borrower is really paying for that insurance again. So in USDA, it's just to promote the asset class and like local rural properties, and VA just to support the veterans. The government takes the bill to support that. In FHA, the borrower is really paying for it. They are paying for that extra insurance to into an asset class, and on an average, it's between 1.75 to 2%. And if the loan is originated correctly, on an average, a 2% is a normal default rate. Like if we do 100 loans, two of them are just bad. So
Yeah, what a lot of people
that's
don't understand is with government loans, FHA, VA, they don't lend the money. They just guarantee that the
no,
lender's going to get paid. That's all they do. Yeah.
yeah, they're just guaranteeing, and borrower is paying for that insurance.
Yep.
Yes, they
Yeah.
are.
The it's coming from the bank.
Mhm.
Yeah.
How
I
Yeah.
out
apologize for
in
the technology not working well with me today. I had to come in and go out a couple of times. The good news is interest rates are really low right now, relatively speaking. These are the lowest interest
Yeah.
rates we've seen in the last 3 springs. 3 springs.
Yeah.
Yeah. And
Yeah. Yeah.
so how is that affecting your business, Amish? Is it better or worse? Do you like it when the rates are higher and you like them? Yeah.
It's getting busy. If believe it or not, this Monday I stopped advertisements. I'm like, I cannot handle this. There's just so much business going on. I'm not able to like keep up with stuff that is in the pipeline. I was like, this is the first time in last 7 years that I've said, okay, like I think I need to like figure out a way to slow down or increase the team and do something more. So and on an average, we are quoting at like 4.75 for 15-year fixed with higher loan amounts and good credit and reasonable loan to values. And on the even on the investor loans for DSCR with like rental property investments, the rates are like 5.5. So it's really amazing time to be buying. Not a lot of people have figured it out. I think Brandon is on top of stuff and he knows what's going on, and maybe that's why you also had a lot of fun.
I'm actually shocked that we don't have lines around the corner of every real estate office in town, because this is as good as it's going to get. You know, I mean,
Yeah, people have not realized it. The people that are buying right now are at the best situation because rates are going to continue reducing, and not enough people have even figured out that the rates are low. They are still thinking the rates are high.
but the prices are continuing they're going to continue to go up. So you got to jump on
Yeah.
this train as soon as you can, you know? So
Yeah, this is the right time to be buying. It could be a first-time home buyer. It could be investment properties, commercial properties. A lot of commercial properties were really struggling for last 4 or 5 years, right? With high interest rates, things just wouldn't make sense. Like nothing would break even, and if somebody bought it, they would break rather than break even on the financial spreadsheet. So this is a great time to be buying.
Are you finding out in
Yeah,
your
go
neck of
ahead,
the woods that commercial lending is that so the reason last 4 or 5 years locally the commercial lending has been real scarce. Our local banks are just being real picky with what projects they're going to go with. They reduce
Yeah.
their amount of money that they have per year to spend. So I know that was a direct factor in our area here in Western New York. How about out there in North Carolina?
I think money has been available. I was actually surprised just how much money is available. Even if the rates were high, the guidelines kept getting more and more easy over here on the West Coast. But as you said, like the total amount of loans originated is down to like California is very, very rate sensitive market. So it's almost down to 20% of the peaks. Like out of $1 trillion, it's come down to like 200 billion. So it's like the guidelines have become easier, but originating loans has been more challenging because properties will not make sense with a higher interest rate.
Yep. Okay.
I see. We're coming down to the final stages of our descent pattern on our podcast. Amish, final words for you?
Yeah, I would just say it's a great time to invest in real estate. There is no wrong asset class. I would say explore a little more of debt investments. 3% interest rate loan can still get you a 20% return. So when the money moves between primary markets to secondary markets and within the secondary markets, there's just so much money to be made in debt investments as well.
I'm anxious to hear some of your comments that I missed because of cyberspace issues. So I'm going to bring myself up to speed. Matt, final words.
Yeah, thank you very much, Amish. I appreciate your time and your input here. It was very useful to our listeners. And please like, follow, subscribe. Thanks for tuning into our show.
Always.
Thank you. Thanks. Thanks,
Thanks
Matt.
for having us. And do you have any contact information you want to share, Amish?
It's pretty easy. Munshi Capital, munshi.biz, 877-343-7379. You can reach me on whichever way you prefer, and I'm generally responsive 24 hours a day,
Okay.
as most of real estate professionals are.
Yeah.
Beautiful. And I'm Brendan Cunningham,
Excellent.
the real estate
Thank you.
doctor here. We always want to tell you the real story, what you want to hear, what you need to know as opposed to what you want to hear. And together, Matt and I tune in because we are those real
those real
estate guys.
estate guys. Great. Thank you, Amish. Appreciate it. I don't know.